Welcome to Pro News Weekly. Let's dive into the latest updates from the financial markets. The US dollar is regaining momentum. Stock indices are being driven by FOMO. Gold has been on a roller coaster ride, and crypto whales are pushing Bitcoin lower. The US dollar quickly recouped its losses thanks to Donald Trump's latest comments. Concerns over potential disruptions to energy supply routes have driven market volatility. The promise to send Iran back to the Stone Age contrasted with his earlier statement that he would end the conflict within 2 to 3 weeks. This shift in sentiment reversed the euro's recent gains, sending Euro-USD lower after a few days of upward movement. Polymarket participants estimate the chances of the war between the US and Iran ending by the end of June at 65%. A closure of the Strait of Hormuz before then would be a real disaster for the global economy. The IEA warns that the oil market deficit will continue to widen. In March, the market remained stable due to the supply from the previous month. However, in April, conditions risk deteriorating rapidly, suggesting that additional releases from strategic reserves may be required. The euro is gradually losing its key support from expectations of aggressive monetary tightening. Investors are beginning to question the ECB's past decisions. Was the biggest mistake in 2022 when it underestimated the inflationary impact of the energy crisis? Or in 2011, when it raised rates in response to rising prices? That earlier tightening weakened the Eurozone economy and ultimately forced the central bank to cut rates more aggressively than before. It's often said that markets take the stairs up and the elevator down. However, a sharp rally following America's Liberation Day and the COVID-related slump are keeping investors on their toes. In the earlier part of last year, there was an 11% decline in the S&P 500, followed by a 37% rise from this low by the end of 2025, whilst the Nasdaq Composite gained a staggering 12% on a single day in April. No one wants to miss a repeat situation and find themselves on the wrong side of the post-war rally. That is why investors are following the news from the Middle East with anticipation. Donald Trump's statement that the conflict would last another 2 to 3 weeks allowed the S&P 500 to find its footing and bounce back. One important pattern has emerged in the broad stock index's performance. It starts the week on a positive note, but sees heavy selling on Thursday and Friday, trying to cut market exposure before the weekend, when the US president often delivers surprising comments. According to him, the bombing of Iran will intensify, and its energy infrastructure could be targeted if Tehran fails to sign the agreement and reopen the Strait of Hormuz. This points to a potential escalation of the conflict, which is putting pressure on the S&P 500. Gold ended March with its worst performance since October 2008. At the start of the week, the precious metal surged towards $4,800 per ounce as optimism built up, but the bull party didn't last long. Donald Trump often confuses wishful thinking with reality. His messaging has remained uncertain, with limited clarity on how the conflict with Iran could be resolved soon. He reiterated an ultimatum to Tehran, linking potential military action on energy infrastructure to the reopening of the Strait of Hormuz and a possible peace agreement. Similar approaches in the past have had little impact on the situation. The markets interpreted this as an escalation of the geopolitical conflict, causing gold to retreat. Despite the mixed dynamics, Goldman Sachs maintained its year-end gold price forecast of $5,400, citing 2 Fed rate cuts and major central bank activity in the bullion market. Neither the growing appetite of institutional investors nor the inflow of capital into Bitcoin-focused ETFs or the active increase of holdings by crypto treasuries are helping Bitcoin break out of the midterm consolidation range of 60,000 to 75,000. Instead, signs of de-escalation in the Middle East have dampened sentiment, leading to a sell-off in cryptocurrencies. According to CryptoQuant, the main reason is the persistent desire of large holders, or so-called crypto whales, to offload their tokens. The company views the current consolidation as an accumulation of short positions rather than long ones. In its view, even the end of the war in Iran would provide only short-term support. On the other hand, an extended conflict, rising oil prices, and a deterioration in global risk appetite are likely to put pressure on risk-sensitive assets, such as Bitcoin. The release of the minutes from the March FOMC meeting and the publication of U.S. inflation data, the PCE price index, and the CPI will be the key events on the economic calendar next week. Investors will also be interested in data on U.S. durable goods orders, the Canadian labor market, and the Reserve Bank of New Zealand meeting. However, until the conflict is resolved, geopolitics will remain the main driver of price movements in the forex market. Trump's threats against Iran, followed by a retreat, are affecting various assets. However, it is important to understand that investors are facing the most significant disruptions to oil supplies in history. This situation is providing a tailwind for the US dollar as a safe haven currency. Keep up to date with global market developments in Pro News Weekly. Like, share, and subscribe.